call him stepsister. She lives with. He called her, and she got, of course, got mad because we called her. So like, he's like, "Is mom there?" And she's like, "Yeah, she's sitting right in front of me." So she handed her the phone, and Mark's like, "Mom, some man just called Sandy from your phone number." She's like, "Well, that's awful funny. My phone's dead on the charger."
I got a weird phone call one day, and I called it back, and this guy answered, and he said that he told me, he said, "Yeah, there was one day, me and my wife were sitting right next to each other watching TV, and her phone called mine."
It was so weird. Savannah's old phone number that she had, my granddaughter's, that she had one of the government phones. My daughter had got a government phone. We turned around and added my daughter to the plan, so then she gave her phone to Savannah. And we're sitting there, and Savannah's phone just kept calling us. Nobody was on her phone. Because when we all eat or something, our phones are left somewhere else. And we could see Savannah's phone. What the heck? So we switched her phone and put her on our plan so we don't have to deal with that anymore. But it was just, we're getting crazy.
That's how they do that spoofing and stuff.
And then,
Swatting and that, they use that to.
I don't know how many times I've gotten calls from some law enforcement agency that they're coming to arrest me. I said, "Bring it on."
You know what I tell him? I'm looking forward to a vacation.
Are you doing that day?
Thank you. I'm not the only one.
At the office, are you?
And if you cuss at them, they'll cuss
Yeah,
back.
Mondays and Wednesdays.
So you know it.
Office
no,
hours.
I
Certain
kids don't.
tax school, and mine doesn't agree with that. So once we're done here at tax school on Monday.
Even if
Wednesday, I
you're
go to the
like
office.
waiting on a call from, let's say your car's in the shop, and you don't have that number in your contacts,
That's the only.
can they text you?
That's the only downside, because, if it's not,
Is Amy
it
gonna
will
be
just
this
show
year?
it never doesn't ring or
Oh.
anything, so I just gotta leave a message.
Yeah, I changed my voicemail on myself that says, "Hey, thanks for calling. If you're calling for Liberty Tax, leave a message and I will call you back."
We don't
In the
have.
middle.
we don't
And
have to
people
worry
still
about
don't leave a
it.
message.
Oh, no, oh.
Yeah, that's the only thing,
Like my 5 o'clock appointment, Mossberry, she called, and I was like dozing in the chair, so I didn't answer it. I was taking a little siesta.
Yeah.
And she called right back. I was like, okay, so I answered it. And she was like, "Is this Liberty Tax?" I said, "Yeah. What can I help you with?" I'm supposed to have a call at 12:00. And I said, "Yeah, it's with me. I'll be there about 4:45. When I got here at 4:30, she was already here. So, but at least she came early.
Yeah.
Because my 11 o'clock didn't even show.
Alright, so let's talk about chapter 6 today, retirement benefits and IRAs, as far as income is concerned. There's some tax credits that could be talked about, but that's for a future chapter. In this chapter, we're going to talk about Social Security benefits, retirement income, the common types of retirement plans, contributions, distributions, the simplified method for figuring out the first year of a pension or annuity distribution, required minimum distributions, qualified charitable distributions, rollovers, penalties, and early distributions. Lots of penalties going on here. So we're going to try and learn how to determine the taxable portion of Social Security benefits. Might not be. Might be taxed at 80%. We don't know. Learn about different types of retirement plans. We've already kind of covered some of that. Determine the taxable, non-taxable portion of retirement distributions. Well, if you're reporting at work, yeah, that's all taxable. How to use the simplified method. Distinguish between different types of IRAs and their benefits. Learn about rollovers and direct transfers between your retirement accounts. Understand the rules, penalties, and exceptions associated with retirement accounts. All right. So first and foremost, Social Security benefits. Title II of the Social Security Act basically goes back to what, 1934? Yeah. Part of the Roosevelt administration. It's still in place. Second Roosevelt, not the first one.
FDR.
Yeah.
Not Teddy. Big Luke
Huh?
Big Luke
They include old age, survivor, and disability insurance benefits. Certain government retirees who receive a pension from work are not covered by Social Security. They didn't pay into the Social Security plan. They paid into something else.
And you'll know who they are because they will have a 1099-R that says CSA on it. The 1099 CSA. Yeah. That is their Social Security. Sorta.
Yeah.
Well,
And the problem is it doesn't look all that different from their 1099-R from their government pension.
right. Right. The only difference is it's typically non-taxable across all platforms, federal and state.
Current Social Security system works like this. When you work, you pay taxes into the system. Social Security taxes are collected from all workers and used to pay benefits to people who have already retired, people who are disabled, survivors of the deceased workers, and dependents of beneficiaries. Your money goes into a trust fund. It doesn't go into an account that's for you.
Which pisses me off when I hear the federal government saying, our biggest expenditure is Social Security. No, it's not, because it's not even part of the federal freaking budget.
Okay. Your biggest income source is also
Social Security.
Social Security tax. So shut up and don't tell me it's a freaking entitlement, because it ain't.
No, you pay into it for however many years you work. It's not an entitlement, it's a government-backed retirement plan.
Right. That you paid into. Unlike federal income tax that's held into a dedicated account under your name and Social Security number, the Social Security taxes that are paid now are not held in a personal account for you to use later. Because they're spending it right now on the people who are already retired, who are already receiving benefits. Any unused money goes into the Social Security trust funds, not into a personal account with your name on it. One of the biggest investors in the U.S. government is the U.S. government through the Social Security trust funds. Benefits are the monetary benefits received by retired workers who have paid into the system. They're paid out monthly to retired workers, their spouses and/or surviving spouse and/or surviving dependents. Those who are usually paid permanently and totally disabled according to the strict criteria set forth by Social Security. Social Security supplemental income is never taxable. We don't have to worry about that. You get SSI, don't need to see if that's your only income.
Well, why the heck do they send the 1099 for that?
For your record.
Not SSI.
They don't send it for that.
My daughter gets one for hers.
She gets SSDI.
Yeah.
Oh, okay.
Supplemental security income, all you will get is a awards letter at the beginning of the year telling you what your new monthly amount is. You actually will not get a 1099 for supplemental security income. But you can use it as income to prove that you qualify for credit.
Like homestead.
Well, here's another way to tell the difference.
Like homestead or earned income credit
Has
if
she
you
ever worked?
have earned income.
She's never worked.
No.
And she might get an SSI because SSDI, you have to work.
Okay, her SSDI is off of the sperm donor.
Oh.
Okay,
That
okay,
after
okay.
the first of the year, we go to court and it'll be off of marks then.
Okay, alright.
Yeah.
Yeah.
Okay, so that's
that's-
it.
see,
It's a
that's
death
what had
benefit,
me-
or it's a benefit from,
It had me confused because she
Yeah.
gets two separate checks, one on the first, one on the third. But we get this stupid statement.
Yep.
And I'm like, what the heck is she supposed to do with it?
So one of them is probably the supplemental security income,
And then the
and
other
the
one
other
is
one is a
SSDI.
spousal's benefit.
not spouse, parent.
Okay, parent benefit, yeah.
Yeah, okay.
It's just proof of income.
Yeah, it's not that big.
Yeah.
If she was working, then she would have to claim it,
Yeah.
and that's why she would need that form.
The unfortunate thing is the amount that's on her SSA 1099 can become taxable income.
Yep, if she works.
Or if she files a joint return to somebody else who works.
Oh, yeah, yeah. Mine gets hit 85%.
All right. Well, this one's a little. I see a big typo up here.
Uh-oh,
Which,
where's it at?
Oh, okay.
You find it? It's not in the text. It's on the form.
Oh,
I can't read that.
I can't see the form from way back here.
Okay. Well,
Well, we can, but we still can't.
unfortunately, this form says SSA 1042S.
Yeah.
1042S.
Yeah,
What is a 1042?
And down here it says SSA 1042S-SM.
1099,
I'm
Which
looking
one
it
is
up. I'm
correct?
looking it up.
This should be a 1099 SSA. I think they downloaded a sample.
1042, what did you say?
S.
S.
Yes.
SSA 1042S.
It's a 1099.
Foreign persons, U.S. source of income.
Down here at the bottom.
Yeah, okay, so they downloaded the wrong form this year.
Yeah, I was
They
like,
attached the wrong form to the slide. Thank you, Liberty.
So this is the
Well, fortunately, it looks the same.
okay.
It says the Social Security benefit statement is also known as an SSA 1099 or the SSA 1042S.
Yep.
The format's the same.
Okay.
Yes.
Thank God for that.
But it's not in color.
1042,
the real one's
No,
in
well, I mean, unless you have
Yeah, it's
foreign,
pink
you know,
and
so
gray.
no.
Yeah, it's got pink for
Okay,
the great
so-
that.
The SSA 1042S is for non-citizens who received or repaid Social Security benefits for that year.
Yeah. Depending on the amount of other income and filing status, Social Security payments can be entirely tax-free, especially if that's your only income. Don't bother coming in here. I don't need to see you. Unless you have homestead.
We still get those people that they still need to file.
Some portion up to 85% of your benefits that you were paid might be moved into taxable income. Depending on, like we said, your filing status and other income. Social Security benefits are reported to you and the IRS on Form SSA 1099. The structure looks like this. Nice thing about this form, it breaks up our day of black and white because it's got a little bit of salmon color on it.
Did they change something on the percentage of taxable limits
No.
this year with the beautiful bill or whatever?
No. It's still,
It's in limbo. That wasn't part of OBA. It was designed. It was supposed to be part of OBA, but it didn't get included. It was punted down the road a bit.
yes, your Social Security is still taxable if you meet all of the parameters just like any other year, 50%, 85%. What OBA did for Social Security this year, and for the next 3 years, from 25 through 28, is give filers age 65 plus a $6,000 adjustment to income to offset whatever income may be taxable from Social Security.
Yeah, so it's
On
still
the federal
taxable, but now they moved your beginning up amount up 6 grand, basically. Now, Matt is right about everything he said, but there's one aspect, one thing we got to add to it. There is a income phase out.
Yeah, because once
you
you pass 85,000, they just start fixing out to 150, like 150.
75 for singles, 150 for joints.
75.
So if you make $200,000, you don't get the $6,000 adjustment.
Right.
But most of our clients here at Liberty are going to fall well within those guidelines.
Yeah, they'll get the 6. It might not help them completely, but it'll help them somewhat.
It'll offset a little bit.
So the idea, and that's another place where we're probably going to end up with a little bit of struggle because people hear one thing and then don't follow up on it, so they think that none of their benefits are going to be taxable because that was the promise, but that's not what happened.
You tell her the truth, they think you lying.
Yeah, they think that we don't know.
Well, the plus side to it will be is that in some cases, whatever becomes taxable, whatever Social Security becomes taxable, the adjustment could bring that number down so that once we apply the standard deduction to it, it doesn't hurt them nearly as bad.
Yeah,
Because the
brings it
$6,000
down.
or $12,000 adjustment will come before we figure in the standard deduction.
If you were working on the railroad all the live long day, you didn't participate in Social Security. The railroad people have their own version because back in 1934, railroads were something. If it was started today, the railroads would not be exempted like this. So instead of Social Security Administration, they paid into Railroad Retirement Board. And they still do to this day for those people who work for the railroads. Be careful not to confuse the Social Security equivalent benefits with the Railroad Retirement benefits reported on RRB 1099-R. No, the Railroad Retirement benefits are on RRB 1099. Don't confuse that with the RRB 1099-R,
Right.
which is their pension.
Which is very easy to do because the RRB 1099 and the RRB 1099-R are all on the same page.
You got to pay attention.
The first one is the 1099. The second two are the 1099-Rs.
So the RRB 1099 actually is basically the same equivalent of the SSA 1099. It's just from the Railroad Retirement Board. It's still Social Security. It's treated the same. You make too much money, it becomes taxable, and they're the same rules. If you're a retired railroad worker, part of the Tier 1 railroad retirement benefits received are treated as Social Security benefits. For tax purposes, these are called Social Security equivalent benefits, reported on an RRB 1099, payments by the Railroad Retirement Board. And here's the disgusting form that we're talking about. This is the RRB 1099. In a little while, we'll see what the RRB 1099-R looks like. And you'll see that it looks a lot like this.
It's the exact same thing except it has a dash R after it.
Have to pay attention. Fortunately, Wichita's not a big railroad town. You don't get a lot of these. I have one. He works for the K&O.
I had one.
How?
Had one.
Now, if we were in a more railroad town like, say, Newton,
Yes.
you'd see a lot of these. That year I worked in Halstead, I saw a lot of these.
Yeah, and the railroads don't do their employees any kind of service because they will sit there and tell their employees that this amount on this document is tax-free. They don't have to worry about paying taxes on it.
which is a lie.
Argued over an entire holiday with my brother, who works for Burlington Northern Santa Fe, because he assured me that Burlington Northern told him that what was on his version of Social Security was not taxable at all, period. I said, well,
There's an asterisk next to the period.
So they have the same rules that the regular SSA, right?
Yes, Form SSA 1099, Form RRB 1099 use the same worksheets, follow the same rules to determine if any of the benefits are taxable.
Yep.
Report Social Security benefits on the tax return to the person with the legal right to receive them. So if it's for a child, it would go on their tax return, not the parents. Don't get me wrong, I love seeing an SSA 1099 for children.
residency.
It's my best residency document in the world. And if they were doing a tax return, I would put it on there. The name and Social Security number of the owner of the benefits are shown in boxes 1 and 2 of SSA 1099, or box 2 of the RRB 1099. If a child receives benefits, the check may be in the parent's name, but they don't belong to the parent, they actually belong to the child. So once a year, the Social Security Administration sends out a letter saying, hey, we sent you all this money for this child, what did you do with it? And the last thing that they want to hear is, we put it in savings.
Yes.
Because you can't have savings over $2,000.
They don't like that. I was able to convince my guy, though, that in this case it was in his long-term best interest. Because he had a disability himself.
And wouldn't be staying at home forever.
He needed something to lean back on. And I got them to accept the argument that due to his disability, having a saving, putting it into savings is actually in his long-term benefit.
Now, had his dependent, once he was not living at home anymore, had to live in a group home environment, res care, something like that, that argument would never have flown.
No.
But because he's actually capable of living on his own, little different scenario.
So Jane and her son Willie received Social Security survivor benefits. Willie received an SSA 1099 with his name in box 1 and his Social Security number in box 2. Box 5 showed benefits of $2,000. Jada received an SSA 1099 with her net benefits of $5,000 in her name. She will only use the amount of $5,000 to figure out if any of her taxes benefits are taxable. Willie must consider the $2,000 in addition to any other taxable income he received to see if any of his benefits are taxable. If Willie has no other income and no taxes withheld, Willie has no reason to file a tax return. Some percentage of your benefits will be taxable if your total income, including tax-exempt interest, plus 1/2 of the net benefits in box 5 of your SSA 1099, which kind of sucks, exceeds the base amount for a filing status. If you're married, filing jointly, and both spouses receive benefits, use 1/2 of the combined benefits. You don't have to look at it at an individual basis. Generally, as your total income plus 1/2 of your benefits amount increases, a greater percentage of your benefits are subject to tax. If the base amount, if you're married filing separately and live with your spouse at any time, that means 1 day, during the year is 0, which will always result in some of your benefits being taxable. So you're going to be married, filing separately, and you were living with your spouse and you receive Social Security benefits, regardless of whether you had any other income, your benefits are going to be taxable.
If you're working at the same time that you're collecting Social Security, once you pass, like, let's say for a single guy, 75,000, everything is taxable, regular tax stuff. There's no penalties or anything else. So
And there's no-
limit
there's-
between
and there's
62 and 65.
See, and that's where people get confused because they'll say how much because they think and here's the two different pools that you're dealing with. Somebody's on disability and receiving benefits. There's only so much they can earn before they get penalized. And that's where people get confused because then they think, well, that's Social Security. So then they take it to your scenario and say, well, okay, I'm 67, I'm going to retire, but I still need to work or still want to work. How much money can I make before I get penalized? The answer is actually, for the basis of the actual question that you just asked, which is a fun part, you can make as much as you want.
Most people don't ask before I get penalized.
Yeah.
They just say, I'm retiring, how much money can I make while I'm on retirement?
Yeah.
And
You
the
can
Social
make-
Security Administration will say, make as much as you want.
Yeah, exactly. That's the answer to the question that you technically asked. You asked, how much can I work before my benefits get affected? If you're retired, if you're on disability, there is a number. If you're retired, there is not a number, and that's the question that gets asked. And the Social Security Administration just answered that question. Brenda had this. She sat at that desk. She called the Social Security Administration with the client who was fighting with her. Because he asked the question just like you did. He got the answer just like we said. And he said it again. He asked the question. He got the answer. Same. He didn't change it. Brenda then came on and rearranged the question. But the question really he's needing to ask is how much can he work before his benefits become taxable? Social Security Administration said, well, he didn't ask that question. And they're not going to answer something he didn't ask.
Right.
But isn't that
They're not going to volunteer any
dependent
information.
now? I mean, age dependent.
No.
Like if you do work in 62 and 65, there's a limit different from if you're 65 and on.
Yes.
Yes and no.
Yes, from 62 to 65 or 66, depending upon when you were born, what your full retirement age is. If you take early retirement and you're working, there is a set amount of money that you have to stay under to keep your benefit at that level. Otherwise, they start taking money out of that benefit because you're still working a full-time job. You don't need the retirement.
You shouldn't have retired.
You shouldn't have retired.
It's
But
kind of
once
what they're saying.
Once you hit that 100% retirement age, if you want to work 40 hours a week at 68 years old, you can work 40 hours a week at 68 years old. Understand, depending upon your filing status, between 50 and 85% of your Social Security retirement benefits are going to become taxable income.
Yeah, because it's part of your income.
Right.
Regardless. But then they're not gonna tax 100%.
It's never 100%. And
Yeah.
and by the way, your core question actually isn't a tax question at all.
Oh. So we don't.
We don't deal with that because that's a Social Security fix, changing benefits around, has nothing to do with taxes.
So the form would come already calculated.
Right.
And all that stuff, you know.
Yes.
So they know when you're working before they send the form out.
Right. They've made the adjustment already.
Yeah, I just got a letter yesterday from Social Security that says, hey, we've received reports that you're still putting into Social Security, this is the listed employers that we show that are approved for you. If this is not true, give us a call. We've got some stuff to talk about. If this is true, don't worry about anything. If you're working for somebody else, we need to know.
All right, so back to Brenda's client and the question he should have been asking. Here's his questions. At what level can I work up to, income-wise, before my benefits become taxable? Now keep in mind, this is his income plus 1/2 of the benefits he receives. So, first amount for the married filing jointly people, they can make collectively $32,000. So, whatever their income is plus 1/2 the Social Security benefits, as long as they stay below 32, it's not taxed. Once they breach 32, it becomes taxable at 50% of the benefits become taxable. Head of household, qualified willers, the number's at 25. Married filing separately and lived apart all year, the number's 25. Your benefits become taxable immediately if you're married filing separately and live together at any time during the year. So that's the 50% amount. The maximum amount is 85%. And you can see the window's not that big. So now I'm at 85% of my benefits being taxable if my income is $44,000 or more. Not a big gap between 32 and 44. Head of household, qualified willers are 34, married filing separately, lived apart 34. And again, 0 if you're married filing separately with your spouse lived with you all year. So really this line here is redundant to that line. If you lived with your spouse at any time during the year and received Social Security benefits, you're automatically going to be taxed on 85% of those benefits, regardless of whatever else happened. So don't do it. Unless you have a very, very, very good reason. Figure the amount taxable benefits. Total income is generally all your taxable income. So lines 1, 2B, 3B, 4B, 5B, 7, 8, plus tax exempt interest from 2A, minus adjustments from Schedule 1, lines 11 through 20, line 23, and line 25. Which we'll talk about those lines at a future date. The following exclusions adjustments must also be included in income. Employer-provided adoption benefits excluded, foreign earned income, and or the foreign housing exemption. Fortunately, my Dubai guy who has that line right there isn't retired. He's still a ways from it, too. I imagine they probably put plywood on the door.
I was like,
There's only one cop over there now.
Still?
One, yeah. The other cop left.
I thought they'd be done by now. Income earned in America or Samoa or Puerto Rico by a bona fide resident must be included in this income. Of course, that's a special return, and so we'd have to send it off to corporate anyway. Of course, this is the IRS, so if you want to actually figure out the taxable benefits of the taxability of your benefits, they have a worksheet for you. Found in the 1040 instructions, if you happen to find a copy of them, which they're available on a PDF online from the IRS website. Just pay attention when you do IRS website things for PDF that you get the proper year. Even if I type in publication 17 for 2025, it might not be the first return. So very much pay attention to what year you're about to click. Make sure it's for the year that you're doing. If I'm doing a 22 return, publication 17 information doesn't help me if it's 25s. Might be a decent guideline, but the numbers are all wrong. So we got to keep that in mind. If you take certain exclusions from income or received a lump sum payment of Social Security benefits, there's worksheets found in publication 915. This is yet to be a little bit messy, but sometimes it takes a little bit of time for the Social Security Administration to decide whether or not you are eligible for benefits. And if it takes a year or two, and then they decide that they give it to you, they give it to you retroactively in one lump sum payment,
Which you have to pay taxes.
which I might be working by that time. And so all of a sudden, like you said, if I'd have got it in those previous years when I wasn't working, I wouldn't have to pay tax on any of it. But they gave it to me this big number this year, and I was kind of working a little bit, and it became taxable. So I have this big, huge number that could be subject to tax. Well, fortunately, they have a worksheet for that. So I can spread this big lump sum out back to the previous couple of years. How many every years? It'll say on the form. This covers. So I can spread that out.
A lot of times on those lump sum payments at the bottom left corner, it'll say 2023, X amount of dollars, 2022, X amount of dollars.
Yeah.
And all of those numbers are figured into that total benefit amount.
Right. But there's a worksheet that helps you break that back out. So if you were subject to tax on the payment, you're only going to pay tax on this year's. You're able to break the previous years out.
Now for that, you gotta submit that, call when you readjust your filing.
You have to amend any.
Amend it.
No, it's covered by the worksheet. Even if in that previous year I might have owed tax on it at that year, still covered by the worksheet. You don't need to go back and file an amended return for those. The worksheet does the work. So it will ask you those questions. It's fun. Fortunately, the IRS has gotten a lot better about it. And so, like Matt said, we've both seen it where it's gone back 3-4 years, but they're better about it now. And the past couple years, the worst I've seen has only just been a year. Yeah.
Well, Social Security doesn't go back but 2 years
Yeah.
Yeah, they changed
They did change that rule.
Yeah.
And on our system, if you get something like that, and you want to make sure, if you get a SSA 1099 that has lump sum distributions on there and it breaks it out at the bottom corner, we do have a button that you can click for lump sum payment.
Yep.
So when you're filling out that SSA 1099, if you click that the total benefit amount is a lump sum payment.
Yeah, they'll start the worksheet for you.
Yep.
The program is actually really good.
Yeah.
I mean, I hate to say it, the program's so good is that you could be a total novice. You're just plugging in numbers, the program will do all of it. The idea behind this class is to be able to explain why this happens. Anybody can fill the program. Anybody can run the program. All you have to do is type. Can you follow instructions? Yes. Okay, well, then you can do this.
TurboTax is a decent tax program.
Yeah.
If you understand what you're doing.
Yeah, it gets better the more you know. Well, the same here. I could be a sufficient tax preparer just by plugging in numbers. I become a great tax preparer by knowing what happened.
Why it happened, how we can prevent it from happening again.
Right. And then expressing that to the client. Because one thing that I haven't been hammering, because we haven't quite gotten into those scenarios, but I'm looking at this year's tax return and I'm realizing that all things being equal, next year's tax return is going to look different because you're about to, say, for instance, have a child that's no longer going to be eligible for child tax credit. Well, that's going to play havoc on your tax return. Because that $2,000 credit that you were getting doesn't exist anymore for you.
Our biggest issue was because they didn't hold any state or federal.
Yeah, that too.
Yeah, and so, we're back and forth on that. Being able to explain to the client why they owe this much. This is the idea behind the entire class, is being able to say, okay, this is why you owe. Here, here, and here. This is how you fix it. You do this, you do that, you do this.
Those are usually our first two explanations, and our third one is this.
So what do I do? Well, you have voluntary withholdings perhaps on your Social Security benefits.
So you-
Or this is a one-off thing. Here's the big thing is that the guy didn't retire until late in the year. He worked until November, then he retired. This would be my wife. Her birthday's in November. This is Shannon. Her birthday's Suzanne. Her birthday's in November. They're going to work that last year, most of the year. So when they retire, actually, they're probably going to end up paying tax at least on that first year on their benefits. And probably at the maximum amount.
That plus at the end of the year, I would advise waiting until after the first of the year to retire.
Yeah.
Because at that point, it doesn't matter a month or two.
Yeah, a month or two is not going to be that big a deal. But you can see where I'm going with that. And again, that's where a good tax preparer would be pointing that out. Client's telling me he's going to retire next year. I'm in front of this already. Oh yeah, when are you going to retire? What month? Hey, you're going to work up until there. You're going to continue to work or not. So on and so forth. You can see where I'm going with this. I'm heading my client off already from getting a big tax bill next year. And he's going to recognize that and realize that I know what the hell I'm doing and be a lot more receptive to my advice. And very much more likely to come back in future years because I just didn't do his taxes. I looked out for him.
Now, the Social Security, they calculate how much you made of the year or how much you made per month.
Oh, okay.
The pot just
I
ended.
just turned that thing on.
Yeah, I
It's not.
turned it off and remade a pocket.
What do you mean?
Yeah, because a friend of mine, he was retired, and he was telling me that what it really matters is how much you make per month, so.
When we're talking about taxability, we're talking about how much you made for the year.
Yep.
Yes.
But how they figure Social Security is off the most worked 10-year period in your lifetime. And that's how they match to, so you're used to that lifestyle at that, and that's what they try to continue with.
Take your last 10 years.
Your best working period to get your Social Security. Your disability also,
Yeah. So-
base disability, that way too.
So when you turn it on,
Thank you.
Social Security doesn't say, okay, well, how much you're making per month, taking per month.
They do it out of your history, not your,
Out of your annual work history, what you've paid in
Okay.
over that last 10-year period, and then they figure out the monthly amount. If you go on to SSA.gov, you can create an account, go in, and they will outline everything. If you
What you've
retire
done
at
in
this
your
age, this
For a
age,
while,
this
they
age,
actually
this
sent a
age.
letter out.
Yeah, they
Yeah.
do now, they do, because everything's online.
Usually around 60, 61, they start sending letters out every year. If you retire, and it'll break it down from 62 to 70. If you retire at this age, this is your monthly benefit. If you retire at this age, this is your monthly benefit. If you're on disability, this is your monthly benefit.
Yeah, I get mine a letter every 5 years now. We used to get it every year.
yeah, I don't get one
I
at all.
don't get one at all.
Oh,
And neither does.
I haven't either.
So for the client,
And
Yeah,
really-
I'm still second on Starbucks.
And
I
really,
doubled it to-
in my scenario, thank you.
I've
I
only
will-
had 3 hours sleep, so
I would
need it.
probably be
Yeah,
better
yeah,
off by
exactly.
using my wife.
so for the client, it's best to retire, at the beginning of the year rather than.
If at all possible,
like in
yes.
September.
Like Matt said, hey, especially if I have a November birthday, a September, October, fourth quarter birthday. Yeah, it might make more sense just to wait and retire after the first of the year.
The only people who don't have a choice as to when their retirement kicks in are people who are collecting disability
Which is what
or
I.
supplemental security income. Because at retirement age, whatever your retirement age is, whether it's 66, 67, whatever, when you hit that 100% retirement age, if you're on SSI or you're on Social Security disability, it will automatically switch to retirement.
To the full retirement.
If you are working and you're not collecting Social Security benefits, then once you hit a retirement age, when you retire is totally dependent on you. You know, so if your maximum retirement age is 67 and you have an October birthday, and October of this year you're 67, you can choose to retire now. Understand that if you've worked for the last 10 months, some of that's probably going to become taxable income, or you can wait 3 months to retire, finish working out the year, and January 1st go in, start your retirement, retire from your job, and not have to worry about anything for the following year. If that's your only income.
Right.
If you start drawing your pension from the company you worked for 40 years,
That's a wild card.
then, yeah, that becomes a wild card. We need to see how much what your first monthly payment is, and if those are gonna be static, then you can come down to us. We can plug in your monthly amount for your social security retirement, your monthly amount for your retirement pension, and give you a ballpark about what you'd be looking at for that year.
Because the pension is also becomes taxable income.
Right. Unless you're a government pension.
Then it's non-taxable.
There's so many wild cards in play, aren't there?
Yes.
If I'm taking Roth distributions, if my pension is a Roth, I don't have a problem. Because it's not taxable.
Okay. Now, yeah, that's right. But if it's an IRA,
If it's an IRA, then it's taxable.
Every time you withdraw, it's taxable.
It's taxable, and it's going to count against me when it comes to Social Security benefits. So again, there's another point in favor of the Roth. I can take out 80 grand, and it won't affect my benefits because none of it was taxable.
Now, when does that mandatory withdrawal kicks
71
in
and a
at
half.
70?
Put a pin on that. That's later
Yeah,
this
it's
chapter.
later.
Oh.
It's later.
Because that also
But it's,
throws the whole thing
no,
off.
it's not 71 and a half anymore. It's 72, isn't it?
Yeah,
Yeah,
it moved.
And
All right.
Yeah, COVID.
See, that's why I was never worried about the 90 minutes of this lecture. We're gonna be lucky if we
No, I'm sorry.
No, it's not that. I know because you're getting close. So these are questions that
These
are on your
questions,
mind.
yeah.
So you might as well ask them, and we'll answer the ones that are tax related. All right. So Charles, he's retired. Got a 1099 SSA showing that he got 22,800 in benefits. He has some other income here: 997 in tax exempt interest, 1569 in taxable interest, dividends of 1,500, taxable IRA distributions of 24,119, and a capital gain of $390. Already, I can tell you that at least some of his benefits are going to be taxable because if I take this number plus one half of that number for single, he's already beat 25.
Okay.
So here's his worksheet. We're putting all that in there, and we find out that of his benefits that he received, what was $11,400, $9,579 of his benefits are taxable. Already covered that. Sorry. So, retirement plans. This is a means to save money for retirement while you're still working. That's the idea. You can set up plans through your employer or through financial institutions. Brokers, you go down to the bank and set up retirement plans if you want. The taxability of money put into the plan will determine the treatment of the money when you take it out of the plan. Tax deferred savings occurred when specifically designated accounts or investment options are used that do not require the claiming of the investment income earned from the account from every year on your tax return. Instead, you defer paying taxes on this investment income until you withdraw the money from the account. This is the structure of most people who are participating in a retirement plan at work. Putting into that 401k, going into the SARSEP. They're not paying tax on it today. They're going to pay tax on it at some future date when they take it out. Retirement income may be fully taxable, partially taxable, or not taxable at all. Fortunately, that's not up for us to figure it out. That's up to the brokerage house or bank or whatever financial institution to figure it out. Tax treatment when a distribution is taken out of the account depends on whether the account was funded with before or after tax contributions. If I'm participating in a retirement plan at work, that is a before tax contribution. It was never included in my taxable income. I didn't pay tax on it. It's tax deferred. That's most people. The other one that we have up here is after tax contributions. I took money from my checking account, went to the guy down at the bank and says, I want to put money into an IRA. I've already paid tax on that money. So theoretically, later at a later date, when I take it out, I shouldn't be taxed on it again. I should only be taxed on the amount that it grew, unless I bought a Roth.
News is
The news?
here. Saw somebody with a camera and a tripod walking that way.
They probably listened to the scanner.
I can't believe that's really
And he's
news.
standing right there.
I just watched him that
Yeah,
way.
he stopped. He's
But
standing
with
right
that
there.
being
saying,
Channel
Yeah.
12.
Well, Channel 12 likes this strip mall anyway.
When a business has been hit that close together though, it'll come out. Because it's a pattern.
It is a pattern for the dude that's broke in over there, obviously.
Whenever I show up on TV, it's Channel 12. So
Yes, Shane is our local media personality.
There you go.
I don't like it, but I am. I hate it.
And because he is, whenever they call my office and ask for an interview, I refer them to Shane.
That's why you're getting it, because he's referring them.
Hello.
But then Channel 12 has notes in their file saying that I'm actually knowledgeable and speak clearly enough without a lot of ums, what, ah. No. The telejournalist told me that once.
Oh, really?
They don't want to interview a guy with a lot of
I thought that's their favorite people.
No, they don't
always
want-
interview somebody that's.
No, they don't like that. They like people that are well spoken and don't use
Okay.
Now, public speaking, they teach you not to do that.
Right.
We've been there for that.
It is what it is. I do it because I realize it's best for the company, and I'll take one for the entity. But
We advertise.
I don't like it.
I still think this time of the season starts, we should have magnets or something we can put on our cars or on us.
I liked it for the first couple of years. You had those advertisements for the Get 50 Nows, and you could just kind of hand them out all over the place.
After B&B, we don't do that anymore.
All right, so the gray boxes basically just said what I said before tax. I never pay tax on it as it went in, therefore I pay tax on all of it when I take it out. After tax means that I'm using money that I've already paid tax on, so that when I take it out, I shouldn't pay tax on it again. I've already paid tax on it. Just whatever comes out that it grew. The interest, for instance.
Roth.
Unless I have a Roth, then I'm totally exempt. And again, it's up to the financial institution, especially in this case, to keep track of what's what. What's taxable, what's not taxable. And it shows up on our 1099-R. So Alicia retired after working 20 years for an electric company. Each year she made after-tax contributions to the electrical company's pension plan. Every year, Alicia paid taxes on the gross amount of her salary, including her pension contribution. That means her pension contributions were made with dollars that had already been taxed. Now that she's receiving payments from the pension, she will not be taxed on the portion that represents her contributions, but she will be taxed on the portion that represents her earnings. Not a bad deal. If you make all the contributions to a plan with pre-tax dollars, the entire distribution is fully taxable. Well, at least it's straightforward. There's no wild card, no variable here whatsoever. I take out 15 grand, I know I'm going to pay tax on 15 grand. This is the most common retirement plan. By making tax-deductible contributions to the plan, you benefit now by reducing your taxable income at this time. And theoretically, when I take it out, I should also benefit again because theoretically, since I'm not working, I should be at a lower tax bracket. So it should be win-win. In theory. Withdrawals are expected to be made later in life, so after retirement, withdrawals from your retirement account before you attain the age of 59 and a half could subject you to additional 10% tax. So not only you're going to pay income tax on the amount that you took out, if you haven't reached 59 and a half yet, you're going to pay that tax plus another 10% early withdrawal penalty. Notice it does say that you could be subject, and there are some exceptions to the rule. For instance, you taking the money out to pay for some higher education expenses. Then I'm exempt from the 10% tax. I still have to pay income tax, but I don't have to pay the extra 10% tax. There are 8 other good reasons that I can think of off the top of my head that are for a future time. Manuel worked for a construction company, made pre-tax contributions to a 401k. Every year, these contributions were not included in box 1 of his W-2, so he never paid any tax on it. Now that he's receiving payments from the plan, all distributions will be fully taxable, both in his initial investments and in all the earnings. That's straightforward. Everything he takes out, tax. There are several types of retirement plans. Pensions. These provide specific payments to an employer or survivor, the beneficiary, after the employee retires from work. The most common one. Annuities provide payments under a contract from an employer or insurance company, trust, or individual. And usually that's a straight line thing. Annuities, lots of equal payments for a set number of years. Defined contribution plans such as 401k, 403b, and simple IRAs allow either the employer or the employee to contribute pre-tax funds. Again, we're back to most of what happens on at work. IRAs are individual retirement agreements set up by the taxpayer with a financial institution or a plan administrator. I can go down to Edward Jones and set up an IRA. I can go to the bank and set up an IRA. And most of these are going to be funded with money that I've already paid tax on. If you're covered by certain kinds of retirement plans, you can choose to have part of your compensation contributed by your employer to a retirement plan rather than have it paid to you. This amount set aside is treated as an employer contribution. This contribution is not included in taxable wages. There is no cost or basis in the plan. Cost or basis meaning that I have money in there that is not subject to tax in this case. I don't. My first job was they had a SARSEP plan. I could put up to 10, they would match up to 5. Well, automatically you put in at least 5% because you're going to get a 5% raise. Just not today. But you can't turn down. You just can't turn that down. For an example, 401k contributions are reflected in box 12 code D of your W-2. And this is the reason this box here is why 1 doesn't match 3 and 5. Which we've already talked about. Elected deferrals and yeah, Matt saw that. Elected deferrals include elective contributions to retirement plans. They could be 401k, the thrift savings plan, which is for civil service employees, the salary reduction simplified employee pension plan, SARSEP, like this is for the mom and pop, like I just referred to. Tax sheltered annuity plans, that's a 403b. A savings incentive match plan for employees, they call that a simple plan. 457B plans, government deferred compensation type plans. All of these basically are kind of the same thing. All the money that's coming out is going to be subject to tax because all the money that went in was never taxed. And the money that grew while it was in there wasn't taxed. Now, I just can't squirrel all my money away into that. There are limits. For 2024, elected deferrals were limited to $23,000. Or to add another $7,500 if you happen to be over 50 years of age. So $30,500. I can't contribute myself into a plan of elective deferrals, so like a 401k. Currently, I could not put in more money than $30,500. That's the limit. If I put in more than that, I am actually subject to a 6% excise tax on the amount I put in over it. So not only should I not do it, there is actually a 6% penalty for doing it if I go over the amount. Simple plans have a limit of 16,000. 457Bs. If permitted by the plan, allow the participant for 3 years prior to the retirement age to contribute the lesser of the twice the annual limit of 23, or the basic annual limit plus the basic limit not to be used over the prior years. The funny thing is that kind of looking at this screen, talking about this information, as a tax preparer, really none of it applies to us. I mean, it's nice to know. But this is up to the plan administrators to keep track of. They should never allow their client to contribute more than they're allowed to. Or once they found out that they've gone over, you are saved if I distribute that money back out to you before the end of the year. Whatever the excess was. As long as you get it back out to you before the end of the year, then it's not subject to the tax. This is just for informational. Like I said, to put this into practice is actually done by the plan administrators. You should not defer more than the lesser of 100% of your taxable compensation or the limit amount. Well, hey, if I only made $15,000, I can't put in 23. They didn't make that much. My limit's 15. And the IRS might have some other questions for me, like, okay, you contributed all your income. What did you live off of, dude?
Stay.
I didn't say it's not possible. I just said it's a relevant question. The employer or plan administrator should apply the proper annual limit when figuring these contributions. However, really, it's the taxpayer that's responsible for keeping track of it. So if the plan administrator doesn't notice it, and it gets to the point where it's time to file your taxes, and you find out that you've gone over, well, that's just you're too bad. It's like the people that were getting that, you know, you look at their W-2 and they had $125 of taxes withheld for the entire year. And they're about to get mad because they only had $125 in taxes held out through the entire year. Well, the question really is why weren't you looking at your paycheck stub and realizing they were only taking up $2 or $3 per pay period? And questioning it back in February or March. What's wrong with you? I mean, it's easy nowadays because you have direct deposit. Hell, I can't think of the last time I actually looked at my paycheck stub. To be honest with you, I get an email every other week. Follow the link; it'll take it to you. I think I looked at it in March, or excuse me, August. Was the last time I actually looked at my paycheck stub. Everything's online. It happens in an ether, So you just, unless you're really thinking of it that day or bored. I think I was at work and we got paid early that week, so when I was at work already, got the emails. Hey, your paycheck stub's online, huh? What the hell? Let's see what it says.
That's what I do. I just clear it because it comes up as an email.
Right.
Like, okay, what's it? Okay, cool. Oh, I made that. Okay, and then I stick it in its folder.
I open it, download it to my phone,
I'll even do
put it
that.
in its own
I
little
don't even-
folder, so I
Yeah, I
have a
don't
copy.
even-
of
But
it.
we're tax people. That's what we do.
Yeah. both
Joe
things.
Blow ain't doing that.
No. As long as money shows up in his account, he's happy.
Yeah. They had no idea that they only had $2 withheld from.
The bad part about that is they want to know from us, who do they bitch to about that?
And really, the answer is go into that room over there, turn around, and above the sink is this
Yep.
Window.
mirror.
Is this window where you can see?
The person
The
responsible.
person is on the other side of the
Yeah.
window.
And admittedly, especially over the last few years, admittedly, the answer to that question, who can they go and bitch to, is their HR or payroll department.
Which is true.
That's
Because-
who we refer them to.
Well,
And I actually go a step further. I print out Kansas and federal, help them fill it out, and send them on their way. Right, Amy?
W-4 and K-4.
Yes.
Yep.
Yeah, I mean, and that's the big
I
thing,
didn't
is
know
when they
you could.
changed that, they didn't properly instruct their employees on how to fill that out.
And the
Well, by law,
instructions
they're
are
not
vague.
allowed to.
Because
What?
the biggest
You're not
problem,
supposed, because you're not a legal something or other.
the biggest problem that we see at our office is husband and wife will come in, husband will have everything taken out like he's supposed to, and the wife will have made $30,000 and had $960 withheld. And she's like, why? I'm like, okay, the first thing we do is we ask them, how did you fill out your W-4?
Yep.
Husband says, well, I filled out my W-4, I put down all the kids. Super. How did you
And the
fill out
wife.
your W-4? Well, I filled out my W-4, told them that my husband was working, and put down all the kids. That's the reason.
Yep.
Go back, redo your W-4, your filing status, and zeros. Your husband's not, don't tell him your husband's working, don't tell him you have any kids or anything else.
They hold out the base.
So that you get the maximum withheld, your husband gets withheld for the kids' credit, and as long as the husband's not telling them that his wife's working, that works.
Right. Well, and then you have the situation where sometimes you have to have one of them claim single.
That's what I do.
That's what I do.
Yep.
I tell them I'm married, but I want to be withheld at the single,
Single
rate,
rate.
and then I turn around and say, "Here, hold some extra."
Yep.
Because I have to.
Yep. That's
Yeah.
what we've done too.
And I've had people ask me that, well, on my filing status, do I have to put down that I'm filing married, filing joint? No.
No.
So you can put down that you're single. And that you want nothing,
Nothing
no,
with
no
it.
credits for kids or anything else, just single and zero. And they said, well, what happens when I file my taxes at the end of the year? I said, nothing. You'll have had plenty of tax money withheld.
he's using the exhaust system.
Hey. Well, you are really late today.
I thought you got lost. I mean, the whole reason why I have to fill out, especially a K4, wife's on capers. If I don't feel I actually have extra withholdings on my state, I'm going to owe the state of Kansas about $100.
Yep.
Because of capers.
He does put the class on
All right, so an individual retirement agreement, an IRA, is a personal savings plans that offer tax advantages. An IRA belongs to one individual. I can't open up a joint IRA for myself and my wife. It's for me. She has to open up hers. An IRA may be traditional or Roth. We've already talked enough by this time that if you can do a Roth, I've given you enough reasons why to do one, but nothing I say is investment advice. I'm not a professional in that department and don't take it as such. I'm a guy with a degree in economics and a minor in finance.
My suggestion would be to open a Roth, but
Consult a professional.
please, hey,
However, I do know what I'm talking about.
consult with somebody that has CFP after their
Yeah,
name.
exactly. Certified financial planner. Traditional, and if you need, I actually have a guy. He's out of a Wellington office, but he's actually halfway decent.
I have a guy too who's in
I might move to the guy in Park City because I doubt he's that busy either. So anyway, a traditional IRA is any IRA that's not a Roth or a simple. You may be able to deduct a contribution to a traditional IRA, and these amounts won't be taxed until distributed. Kind of something for a later chapter. I don't want to get too much bogged down in this, but if I contribute to an IRA with my money, I can write off as an adjustment to income on my 1040 at least some of the amount that I put into it. And I'll come back to that at that future chapter. Contributions to a Roth IRA, on the other hand, are not deductible, and distributions are not taxed if I do it right. So I don't get a write-off on my taxes for putting into a Roth. The tax benefit is when I take it out, I don't pay tax on it. That's your benefit. You'll like it. And you should. Date of contribution, you can make contributions for the current tax year up until the due date of the return, not including extensions. Again, so I will say this now and I will say it again later. I have a couple of clients that come in, have me figure out their taxes. They know they're going to owe. That's their plan. Then they say, okay, I can go put into an IRA and get an adjustment to income, correct? That is true. You can still do that. Come back with the receipt. Well, and then I can plug numbers into the computer to make that amount that they owe go away.
Okay.
Yes, there's the door. And it's all within the rules. Yes, it's after the first of the year, but as long as they do it before April 15th, they can do that. The guy does that. He comes in here, I see, okay, you owe $1,200. All right, how much do I have to put into my IRA to make that a more palatable number? It's not like he's trying to get a big refund. That's not his goal. His goal is zero, if I can get there.
So he does the 1,200 and it does go to zero?
It can.
I don't think we have.
Because you
anybody
can take
that
off-
does that.
You could take off 7,000. Your maximum contribution 775, or depending on the year and your age.
75 and 85 for 25.
Right. So he can go in there and put in that amount, or like I said, he don't want a refund. So if he doesn't need to put in 7.5, if he only needs to put in 5, that's what he wants to do. Well, which would you rather do? Pay your future self or pay the IRS? Not a hard decision. And that's what he does. Comes back, goes down to the bank, comes back in 20 minutes, flows me the receipt, file the return.
Plug the number in, it goes to the IRS, $3, and says, "Ah, not worried."
Yeah.
That's on the traditional.
That's only on traditional IRA. That's only on I paid with money out of my bank account. I've already paid tax on all that money. The problem is, and it's a minor problem, but do keep in mind, he's got to keep track of that money. His plan administrator has to keep track of that money because now he got a preferential tax treatment on some of that money as it went in. Therefore, that when he takes it out, that money is subject to tax. Because he tax benefit going in, it's all going to be taxable coming out. As opposed to some of the things I was talking about before. I contributed, but I didn't take any benefit from it. I don't have to pay tax on any of it as it comes out. I don't have to pay tax on what it grew.
IRA contributions that are after-tax contributions don't typically give you a savings credit on your federal return.
Right. So Charlie contributes to his IRA on April 15th. He can choose to make the contribution for his 2024 tax year, especially if he hasn't filed. And he's going to file today because it's April 15th. Or he could choose to defer that and use it next year. His call. If he makes the 2024 contribution, he may be able to take the IRA as an adjustment of his 24 tax return. Hoping that he hasn't actually filed, because who wants to file an amendment for it?
Well, if he's already filed,
I
I'm
don't-
assuming he's already fine with the fact that he owed what he owed when he filed the return.
Same thing.
At that point, just pay what you owe the federal government.
Contributions to these IRAs are limited to the smaller of your taxable compensation for the year. I only made $500. I'm not allowed to put in $1,000 for obvious reasons. Or $7,000, but Matt gave me the new numbers, and I could have given you the new numbers too because I do have them here. But he's right: 7.5 or 8.5 instead of 7 or 8. So if you're less than 50, you can only put in 7,000. If you're over 50, you can only put in 8. 50 or older, you can only put in 8. If you put in more than that, you are subject to an extra 6% excise tax over contribution. The 50% is required minimum distribution.
Okay, yeah. 50% is the RM. If you don't take enough
That's
RM,
the R&D. Yes, there are a lot of rules. Here's the thing, though. I mean, yes, I'm telling you a lot of rules because there's a lot of possibilities out there. 95% of the people participate through their retirement plan at work. None of these rules apply. In fact, we already covered that screen earlier. They can put up to $23,000. But you'll have to go back and watch the lecture.
23, and if they don't put anything into a Roth, then they get the $7,000 or $8,000 bump on
Yeah.
top of that.
Yeah. Now, if I'm participating in a plan at work, I really can't do this.
Right. Well,
There's some legal.
right.
Very
I can-
little.
I can contribute to my 401k from work out of my own pocket.
Yeah.
And claim that $7,000 or $8,000 bump on top of the 23 I may have already put in from work.
Mm-hmm.
So you could say that you were inclined to, in your 401k, $30,000 a year. If you were inclined.
If you're inclined to. Most people aren't. Taxable compensation includes self-employed income, wages, as well as disability retirement benefits until you reach the age that you could have been eligible to retire. So when we're talking about taxable compensation for being able to take the IRA contribution deduction, that includes wages and salaries, commissions, self-employment income, taxable alimony, non-taxable combat pay, taxable non-tuition fellowship and stipend payments. I can't use earnings and profits from property, so selling my house, interest and dividend incomes, pension or annuity incomes, robbing Peter to pay Paul. I took money out of my IRA to put in a different IRA. No, can't do that. Yeah. Income from certain partnerships or any amounts you exclude from taxable income. It might have been taxable, but I was able to take the foreign housing exemption and exempted all the income. Well, then you can't take the credit. Adjustment to income, not credit. It's not a credit. It's an adjustment to income. If you need a more choking list, go look at publication 590A. Spousal IRA, if you have earned income, even if your spouse does not, you may establish an IRA for your spouse, but only if you're filing jointly. Remember, what was one of the rules to set up an IRA? I have to have taxable compensation. Well, the wife doesn't work, the husband doesn't work. What the other spouse does, that doesn't stop them from being able to put up an IRA. Only one of them, if they're filing jointly, has to have taxable income. When both spouses have multiple IRAs, no more than 7,000 or 8, or now 7.5 and 8.5, may be contributed for each spouse.
Even though they have several IRAs, the total of all the IRAs is
Yeah, it's not a $7,000 limit per IRA. It's a $7,000 limit for all IRAs
per person.
per person. So the most that they can put in is 14. 7 each.
So if a person has got 2 IRAs, the maximum will be 4,000 per IRA. Because then
Well, 7,000 total. I don't care how you get there. You can put 6 in one and 1 in the other. I don't care,
As long as you don't go over it.
as long as you don't go over the limit.
You can do that for you and your spouse.
Right.
That's where you get the 14, 15, and 16.
David and Robin are filing jointly. David's 52, Robin's 48. David's earned income is 56. Robin does not work outside of the home, which is kind of vague. David contributes to $8,000 to an IRA for himself because he can. He's over 50. Robin can put in $7,000 to an IRA, even though she has no taxable compensation showing. And as a tax preparer, my first question actually is that I need clarification on the sentence, we don't work outside of the home.
Yes.
What does that mean exactly? Sorry, I have to ask that question. I need to know.
Does that mean that you are a homemaker and do not have a job, or are you working remotely for IBM?
Exactly. Since 2020, there is no age limit on making contributions to a traditional or a Roth IRA. Before 2019, I couldn't put into a traditional IRA if I'd reached age 70 and a half. Well, because there's a reason for that. As a 70 and a half, I get to the age where I'm triggering a required minimum distribution, which we have yet to talk about. It's coming. So why should I put in money that I've got to turn around and take right back out? Now, a Roth, there's no age for 19 or before. I can't get for.
Oh, okay.
Yeah.
2020, never mind. Okay, never mind, yeah.
Now it's
Yeah, now it's 72, and there's actually
73.
Actually, the stupid thing is that the age limit still doesn't exist, even though the RMD, the required minimum distribution, does. So they need to. That's someplace that needs some work.
73 is the new R&D.
Yeah. All right. So, and Roth, I don't care how old you are, you can put money into it.
Yep.
You can be 90, you can put 105, and put money into a Roth.
The only retirement account you could do that with.
Because there's no age limit, there's no required minimum distribution on a Roth. Now, I've heard some people rumbling around about capping that.
Yeah, but people are living just a little bit longer now too.
I know.
Well, and most financial planners are counseling their clients. If you have a Roth and a traditional or a 401k or whatever, leave your Roth alone and work on that one 401k or that one traditional that's tax deferred. And then once that is completely depleted, then go to your Roth.
Right. Because it makes the most sense.
Right, well, I mean, my folks are at that age where they have to take an RMD out of their tax deferred account, but they don't need that income. So between qualified charitable contributions and rolling it from there into their Roth, that's what they're doing to get around all that.
All right, so the IRA deduction allows you to deduct from your total income the contributions to an IRA, subject to that cap that we've talked about. This is only allowable for contributions to a traditional IRA, not to the 401ks, the 403bs, the SARSEPs, the Simples. They already got their special tax treatment. You don't get the double dip. For the most part, there is an exception to that when we get to tax credits. And I also don't get to take any deduction for putting into a Roth. The Roth itself is the tax benefit. If you're covered at any time by an employer retirement plan, the deductible amount may be reduced or eliminated. If box 13 on your W-2 is checked that you were covered by a retirement plan, that kicks in whether you participated in it at work or not. Just the fact that you were covered by it kicks it in.
The fact that you could have participated in it and didn't.
Right. So in this case, this person is covered by a retirement plan at work. So for an example, we have Nick and Rebecca. They're going to file jointly their total income on line 1 of their 1040 is $130,000. They have traditional IRA. Nick's put in $3,005. Rebecca put in $4. Neither spouse is covered by an employer retirement plan. They could actually put a little bit more. They have some wiggle room. But right now, I'm writing off $7,500. They're reducing their adjusted gross income from $130 to $122.
Actually put in another 65.
Yeah. They can still run down the bank and put in another 65.
Is that because there's two of them?
Yes.
Yeah.
And neither one of them put in the max. They both still have some wiggle. Otherwise, if either spouse is covered by an employer plan, the filing status of the income must be considered. Well, to figure out whether or not you take the IRA deduction. So we're looking at adjusted gross income, or in this case, modified adjusted gross income, which, if I was taking the IRA deduction, is adjusting the income, so I don't get to count that. Modified adjusted gross income. And of course, this is the IRS, so they have a worksheet to help you figure out whether or not you can actually participate, because I was covered by a plan at work. Can I put into my own elsewhere and take the deduction credit? Because the answer is not always yes.
And think, when they say modified adjusted gross income, think of it like this. What they're talking about with a modified adjusted gross income is all of your income combined before anything else happens to it.
Right.
So if you had $180,000 before they started making adjustments for this and for that or whatever, that's your modified adjusted gross.
Right. So going back to the example that, just to help out, that we had 130,
Right.
and then we adjusted it. So the modified adjusted gross income is 130. The actual AGI, adjusted gross income, is what? 122.5
$122,500.
from that previous example.
Yep.
All right. So if I'm covered by a retirement plan at work and single or head of household, if my modified adjusted gross income is $77,000 or less, I can take a full deduction. I can put in 7.5. If I'm between 77 and 87, I can only take partial. Go back to that worksheet to find out how much it is. If I made 87 or more, I can't do it. I can't take the adjustment. Doesn't mean I can't go out and put money in.
You still get credit.
I just don't get an adjustment to income for it. Married, filing jointly, or qualified surviving spouse. You can see the numbers are bigger, but the concept the same. Married filing stupidly. At $10,000, you already, or less, under $10,000, you get a partial. If you made over $10,000, you don't do it at all.
Another reason why we don't recommend married filing.
And I can get bogged down into these scenarios where they sit here. It's like, okay, Donald and Daisy Duck are married. I always do that
I know.
because you automatically just run right there.
Yep.
You can't look at those and not go there.
Uh-huh.
They're both under 50. Donald put in 32. Daisy put in 4. They're going to look at the table based on their adjusted gross income for married filing jointly. They can. Now, if you change that around, remember, this whole thing is being triggered because one or both are covered by a retirement plan at work. Numbers change a little bit if one is covered and the other is not. Shannon's out there. No, Shannon's not out
I'm
there.
right here.
Shannon was smoking out there. Shannon, go take a smoke.
You know you want to
Just
with all
kidding.
those receipts.
Just kidding.
I'll put some
Take your cigarette.
in.
So-
I had 3 hours of sleep and you said Yep.
So in this scenario, Daisy's not covered, but Donald is. Look at their adjusted gross income now at 230. If you thought about the table before, it was capped at 120. At 230, since one of them is not covered, Daisy can still actually contribute and take a $4,000 deduction. So you have these variables flying around. Fortunately, most of the people that I talked about that take this deduction are all single. Remember, the IRA belongs to you, and the contributions to it belong to you. Now, if you're married filing jointly, they still belong to you. They just get lumped together at the end of the day, but you is you. And she looked pissed.
No, it was my resting bitch face thing.
Oh, okay.
No, he was just going to give us Amanda's phone number again.
Ah. Oh, it was the dude. It was not the.
Yeah, it was.
So here's our worksheet for the different scenarios where one's covered by a plan at work and the other is not. How much money can we make before I start limiting the contribution of the person who can? Again, I don't want to spend a lot of time on this because it's really not something we're going to spend a lot of manpower on.
For us, our software streamlines it. It
Well,
lets us know.
And that's the other thing. Matt's right. It's looking at all that information and determining whether or not you're eligible to do that or not. And I could go back into the adjustment income. I could put in $1,000 and change anything. What does that tell me? You can't. You've already hit the max for what you're doing.
Yeah.
So take it back out.
Just don't do what I did one of my first years. I put the birthday in wrong. The guy was getting a $27,000 refund. And I was like, something's not right.
And the guy still comes here and gives her shit every year.
Yep.
And still goes to her. He loves her, but
Oh, yeah, he does.
inevitably that's going to come out. Where's my $23,000?
Mm-hmm.
Still waiting on that refund.
Yeah.
And I know exactly who it is. Although your traditional IRA can be reduced or eliminated, you can still contribute the full amount allowed by law. You just don't get to write it off. If you make non-deductible contributions to an IRA, you need to fill out Form 8606. And you need to continue to fill it out until you take money out of the IRA. If you stop filing 8606, you lose track of what money is in the account that comes out tax-free, and you don't get to go back and fix it. Now 8606 is a standalone form. You could file it by itself if you needed to. If I didn't have to file a tax return that year, I still need to file an 8606. And I could just mail it to the IRS. This type of thing is the big argument for going to the same person, or same outfit at least, year after year. Because once you filled out an 8606 as a Liberty client, you come back next year, it'll automatically be there. Whether you came to my office or went to Matt's office or you went to one in Oregon, it'll be there.
Might wanna wait on Oregon.
Okay.
Why is that?
You went to Bend, not Portland.
Oh, okay.
Fairbanks. Okay, let's put Alaska. You went to Alaska.
Oh,
Screw it all. I'm going to go out and live in the wilderness.
There you go. See?
There is a Liberty Tax Office in Fairbanks.
not staffed year round,
That-
but
Well, the owner, he's one of the bigger power Z's, but yeah, no. And keeping in mind that most of his tax season is in the dark, so he's got waivers out there with flaming batons. Because it's dark.
That would be cool.
It is. I've seen the video.
is Coleman still sending preparers out there every year? Or?
I don't
Remember
know.
they used to do that.
Yeah, they used to have to recruit.
Yeah. You put your name in the hat to volunteer to go to Alaska for the whole tax period,
Yeah, tax season.
tax season. They fly you out, put you up,
What's
do
the
your
pay? I'll
taxes,
go to
fly you
Arkansas.
back. Huh?
What's the pay? I'll go to Arkansas. I'd rather go to Steelers.
Arkansas wasn't. No.
No, that's not.
It was Fairbanks, and there's
No,
reasons
I said
why.
We own, we
Why?
have, because Brett.
Fairbanks
owns the store.
during tax season? I'll give you two reasons. Mostly
Cold as
because the
crap.
sun doesn't come up
24 hours of darkness for like
half
40
the
days?
yeah,
40 days of the tax season?
and
Fair.
well, besides that, it's
52 below at
it's
the high.
52 below. It doesn't warm up. And Anchorage, being there on the coast, it can get to be nice. Fairbanks, no. It's surrounded by mountains. It's in a bowl. It's cold, sinking air.
Remember the movie 30 Days of Night?
Oh,
Think that.
Vampires coming out of town.
yeah.
So, like I said, 8606, you keep track throughout the years of money that you put in. And I can continue to add to it. I can keep putting money into an IRA that I don't get to write off on my taxes. So I can keep adding amounts to this 8606. And like I said, this 8606 is keeping track of money that's in a retirement plan that should come out tax-free. Because I didn't get any tax benefit from it. I've already paid taxes on it. I shouldn't have to pay tax on it twice. Just like I said, once you start filing this, continue to file it. Don't ever skip it. Miss it 1 year, you're done.
It is one of the few forms that is what's called a standalone form.
Mm-hmm.
If you don't have any income and don't need to file a tax return that year, go down, print off your 8606 and file it, even if you have to mail it in.
All right. So, like we say, Roth, retirement plan that's subject to rules that apply to the. There are limits. I can only put in so much money. I can't load it up. It's subject to the same limits as the traditional IRA. However, the tax treatments of the Roths are different. It grows tax-free. It comes out tax-free. I don't get to write it off as a contribution as an adjustment to income. If a Roth, if contributions made only to a Roth, the maximum contribution is the lesser of 7 or 8 if you're 50 or older, or the taxable compensation for the year. And those are the same rules that we have for the IRA. And no, I can hear you thinking, well, what if I put into both? Can I put 7,000 into Roth and 7,000 in traditional? No.
No.
You got one $7,000 pool. Yes. And again, the amount of your contribution is limited based on your filing status and your income level. And again, we can see it married filing separately, you're out in a hurry. Again, that $10,000 is in play. Talking about a Roth, talking about over contributing to any plan. 6% excise tax on the amount that I went over, unless I take it out before the end of the year. But if I decide to leave it in there and I go ahead and pay the 6% excise tax on it, put it on 8606. Showing that not only did I not receive a tax benefit on it, I actually paid the penalty for putting in too much. That way, when it comes out, it's not subject to tax. But your better case in that one is take it out before you pay the tax. Distributions from any pension plan, any retirement plan show up on a 1099-R. Box 1 is the total distribution. Box 2 is telling you how much of it's taxable. So if I have a Roth, box 1 has a number in it, and box 2 has squat. Has nothing in it. And then I go down to box 7, distribution code, and it'll tell me why the number in box 2 is not there. I forget what the Roth is.
Jake, you were Jake.
Yeah.
Yeah. Typically you'll see it in there as a J.
Yeah.
May or may not be, Roth may or may not be subject to. And at that point, if box 2 is left blank and you have a Roth distribution code in box 7, it is completely legitimate for you to put a 0 in box 2 and not leave it blank.
Right.
Especially if in box 3 down below it says taxable amount not determined. It is completely legitimate for you to determine, using your tax knowledge, whether or not any of that distribution is taxable.
Right. Now our bigger problem is that code 7 box 7, and taxable amount not determined, and 2 doesn't match 1. We've got to figure out how much is actually taxable.
Yeah.
They need to go back to their plan administrator and get a number to plug in.
Yep. Yeah, because if it says it's a normal distribution, then technically everything in box 1 should be taxable.
Continue on with boxes on our 1099-R. You should probably have a number on box 4. It's common because taxes will be withheld at the federal level at least. 5 contains taxpayers' after-tax contributions that were received tax-free for the year, or it also represents the basis of this year's distribution. You don't always see a number there. 7 is telling us why this distribution happened in the first place. There could be lots of codes. Normal distribution. Code 7. Code 1. Early distribution, no known exemption. Code 4. Distributed because the account holder has died or is terminal. I could take it out and not be subject to excise tax if I come back from the doctor saying, you're going to die in the next year. Well, I don't need my retirement plan now, do I?
If you're getting distributions from if you're getting a 1099-R for distributions because your dad passed away and his IRA is now being distributed to you, you will have code 4 in box 7.
You will pay regular tax on it, but
Yep.
you're not subject to the extra excise tax for being
Under 59.
under 59 and a half.
You have to pay state taxes for the same distribution.
If I live in Texas, I don't.
Yes.
Oh, all the
Since-
other states.
Since I live in Kansas, yes, I will have a box 14, 15, and 16. You have to pay taxes on it. Yes. So, move to one of the 5 holy states where you don't have to worry about it.
Yeah, the only retirement that's not subject to state tax in Kansas are capers, federal government, state government. And even then, state government is basically capers again.
Yeah.
But if you have somebody with a civil service plan, a CSA, because they work for the federal government, that's not taxable. Military is not taxable at
Right.
the state level.
Yes.
Or they won't tax it at the state level.
Right.
But everything else, and I found this out too, even if you work for the fire department in Dallas for 40 years and you move to Kansas, it's taxable to Kansas.
Don't get any ideas about leaving the state that you paid into the state retirement plan.
Even if you put it in correctly and say this was a city pension, you do that in our system, it'll no, this is not excludable for Kansas, put it back in.
Yep. All right, so back to something that Matt just brought up. U.S. Civil Service and Railroad Retirement Board use their versions, the CSA 1099-R or an RRB 1099-R. This is their pension plan. It's the government retirement plan. And these forms are reporting the distributions from the government retirement plan. Total IRA income shows up in 4A. Taxable portion is on 4B. If you have more than one IRA that's not fully taxable, you figure the taxable part of each separately. And actually that should be done by the plan administrator, not by us, because we don't generally have enough evidence sitting in front of us to figure it out. If the IRA becomes fully taxable, enter it on 4B, leave 4A blank. And that goes true for any other thing on the IRS, on the 1040, or any other form for that matter. If I'm filling out a form paper style, and I don't have any data that goes on that line, don't put anything on that line.
Yeah.
Don't put a dash, don't put a zero, put nothing. Leave it blank. Taxability of pensions and annuities depend on the extent of your contributions to the plan. An employee pension is fully taxable if you do not contribute to the cost. I already basically kind of covered this earlier. If I'm putting in money that's tax deferred, I don't have a basis in it. All of it's taxable as it comes out. If I put money in that I took a tax benefit from, I wrote off as an adjustment to income, I don't have a basis in that. All of it's taxed as it comes out. The only time I have a basis in something is when I used money, put in money that I already paid tax on. That way, when it comes out, I don't have to pay tax on it again. Pensions, generally funded through the elective deferral, so payments would be fully taxable at withdrawal. After-tax contributions are recovered tax-free. If there's a cost basis to recover, part of each payment is excluded from income. So instead of saying, okay, the first $10,000 is free because that's your basis, they spread that $10,000 out over the entire. This is that simplified method. We're starting to lean into that. How much from here on out of this distribution is going to be tax-free? Because I didn't get any tax benefit from it. If the taxable portion of the distribution is reported on 1099-R, CSA 1099-R, or RRB 1099-R. And you missed it, so RRB is the Railroad Retirement Board. Getting less and less using this because the annuity start date is November 18th of 1996. Well, that's 30 years ago. Almost 30 years ago.
Yeah.
I hope you file the tax return between then and now. So, I'm not going to spend a lot of time on this because it really don't. It doesn't happen very much.
If you
Because
have,
they're dead.
typically, if you have an annuity that you're receiving a payment from, you'll get a 1099-R from your annuity administrator, and all that information will be on there.
Exactly. They've already done it. They've already done this worksheet.
Yeah.
They're already telling you the taxable part and the non-taxable part.
Yep.
My box 1 and 2 are different, and that's why. The code will say that this is a pension distribution, an annuity distribution. Disability income. If you retire on disability, the amount must be reported as income. It's here. Employer may report disability income on a W-2 or a 1099-R. If they use a 1099-R, and box 7 is code 3, you get to treat it as earned income, and it's eligible for earned income credit. Otherwise, anything else on 1099-R is not eligible for earned income credit. Disability payments are taxed as wages until you reach the minimum retirement age set by your employer. Well, my wife would fall into a category like this. To help put your mind on it, she's on capers. She gets to retire when her time in service plus her age equal 85, which will be in 2027. Now, yesterday she got concussion at work. No, the day before she got concussion at work. She was trying to break up a fight, got hit in the head.
Ouch.
Now, if she had to retire because of that on disability for the next 2 years, it would be treated as earned income because she can't retire yet. It'd be regular income.
Mine was just straight disability.
I'm just saying. This
Okay.
is. I'm trying to give you an example. I'm not saying this is what would happen.
Right.
I'm just trying to put in your picture, in your head of how it can happen. I'm not saying this is the way it's going to happen. But here's the example. This is how you can be retired on disability but not retired.
And your disability would be paid through the employer, not Social Security.
Yeah, you're not getting it from Social Security. Should be getting it from the school district. She would still be being paid because of work-related injury, so on and so forth.
Yeah, you would get your disability from Social Security.
Different story.
Straight.
Crystal would be getting either a 1099-R from Capers with code 3, or she'd be getting a W-2 from USD 259.
Either way, I get to treat it as earned income, and if we were eligible for earned income credit, I get to do it. But that's how you can be retired on disability and not reach the minimum retirement age. And like I said, for her, December of 2027 is when she hits the minimum retirement age. She can retire. Doesn't mean that she has to. She can.
If they took my teaching certificate, they'll start having seizures.
Well, that sucks. Lump sum distributions is the withdrawal of the entire plan in 1 year. Also gets reported on a 1099-R. If there's any special tax treatment that's available to it, you need a 4972. Yeah, don't worry about that. Excuse me. Traditional IRA is usually funded by deductible contributions, making all the distributions taxable. I wrote it off on my taxes. Therefore, it's taxable when I take it out. When distributed, the payer is generally not required to commit the taxable amount. Plan administrator should be doing that for you. Unless you have an 8606. Roths come out tax-free regardless of what's going on, except for two things. I have to reach the minimum age of 59 and a half, and I've had to have that plan for 5 years. There's a few other exceptions, like if I'm disabled or the beneficiary or I take $10,000 out because I'm buying my first my first house.
Higher education,
Not on Roths,
not on Roths.
just on traditional. Again, that's a future chapter, so I don't want to get bogged down in it. Most common qualified distribution occurs when you're under age 59 and a half. For non-qualified distributions, use 8606 to determine the taxable amount. Especially if I had money in there I don't owe taxes on. Well, if I don't meet these, I have to pay an extra 10% tax. Fun stuff. Required minimum distribution account. I just can't keep my money in traditional IRA until the end of time. There is a certain point where the government says, take the money out. Take some of it out. You have to. Or we will tax you 50% on the amount that you were required to take out and didn't. We don't care what you do with it. Just take it out.
We want our tax money.
Yeah, we want to start collecting taxes on it, basically. Go buy a Cadillac, go on a cruise, put it into a Roth. I don't care. And neither does the government. Just take it out. The plan administrator will send them a letter at the beginning of the year saying, sometime this year you have to take out X dollars. Make sure you take out X dollars.
Now, is this keep changing?
This has been
Every
evolving
year.
because of COVID. It's settled at the 73 for the past few years.
So it's not like something that changes every year, but it's one more.
Everything is subject to the whims of Congress.
Ooh. So they can keep changing.
Remember, we don't blame IRS. The IRS follows the rules. If you want to blame somebody, blame Congress.
And the House, and the Senate,
That's Congress.
all of it. Just don't say that out loud.
So like we said, if you reach age 73, I have to do an RMD. And like I said, your plan administrator will tell you when you have to do this and, how much it will have to be. And like I said, I can do whatever I want with it. I just have to take it out.
So if my birthday was April 2nd and I turned 73, does that mean I don't have to take it out for a whole year?
Yeah. According to that paragraph, this is a true statement. Fun, ain't it? Okay, well, here's one way of getting rid of the money and actually not have to pay or meet my required minimum distribution. Give it away. Qualified charitable distributions. A QCD is generally a non-taxable distribution made directly by the trustee of your IRA to an organization eligible to receive tax-deductible contributions. I'm not going to pay tax on it. It does count as my RMD. Couple rules I have to follow, exactly. Number one is specifically up there. I have to donate it to some place that is tax-deductible. Goodwill. What's not clear up here is the other part is, it does mention it, but let's define it directly. I didn't get the money.
Has to go directly from your
It
plan
has to,
administrator?
exactly. It has to go from Edward Jones to Goodwill.
Yep.
It cannot go from Edward Jones to me to Goodwill.
And you get to claim it as a charitable contribution on your tax return.
Exactly. So I've reached my IRMD. I can do this to do it.
Is there an amount?
No.
So it could be $1 and something.
Oh, do you really want to go through all that hassle for just $1?
I mean, if you think
But I
about
do
it,
have, there are people out there. I do have a couple of clients. They really don't need the money. And the RMD usually is not a huge number. I mean, yes, it's based on the amount of money that's still in the plan. But I think the highest I've seen recently is, they had to take out $700 sometime this year. Big deal. I didn't need the money.
They tell you how much.
Yes.
Okay.
You'll get a letter saying you have to take out $700, $1,000, $1,500, whatever.
Okay, so that's what.
Exactly. So, okay, well, I don't need the money. My Social Security covers it. I don't want to take out any more than I have to, but I have to take some out. What do I want to do?
Tell your plan administrator you want to donate your RMD directly to this organization. Then your administrator, when he makes that donation, will send you a letter saying you did a QCD to this organization for this amount. You bring that letter to me, I put it on your tax return, and that's all there is to it.
Why can't you just give it to a child? I mean, you know, like.
It has to
It has to be
a-
a charitable.
Yeah, organization.
Otherwise, you have to pay tax on it.
Yep.
I can give my RMD to a child. I just have to pay tax on it.
Yeah. You can take your R&D, give it to your kids, but you're gonna get a 1099-R for it.
Well, I'm going to get a 1099-R for the QCD anyway. It's just going to be coded that way.
Right.
That bring down your income or taxes.
No, I just don't owe tax on that money because if I did my qualified charitable distribution correctly, I never had the money, so I don't have to count it as income. That's the whole thing that makes this work. I never had the money. It went from Edward Jones to Goodwill. Never went to me. As soon as it does, this is void.
So you do like church, anything that's.
Whatever is
that's
eligible
listed
to
under
take,
that.
whatever.
Charitable.
Yeah.
Yeah.
Any 501c or
Cancer Society, multiple sclerosis.
Sedgwick County Zoo.
I said KHS.
Yeah.
Yeah.
Kansas Humane Society. Wichita State Scholarship Fund. Don't care. It's just whatever.
Right.
I mean, my guy gave it to the Y.
And your plan administrator will have will be able to furnish you with an entire list of where you can donate it to that qualifies.
Right. My biggest problem is that QCD does have a cap. Qualified charitable distribution is capped at $105,000. And if you're married filing jointly, both of you can have a qualified distribution of 105 each. Yeah, no, I don't. We don't have these clients. I'm not worried about this cap. But do know that it exists.
The person walking in, that husband and wife are donating 105,000 QCD out of their RMD, not coming here. They have a CPA that's doing their books and telling them how much money they have in their account.
Like I said, I've only over the years I've only had one, and it's actually relatively recent. Rollovers, when you transfer your funds made from one type of qualified retirement plan to another type of qualified retirement plan or traditional IRA, the simplest rollover is for the administrator of the old plan to transfer the asset directly to the new plan. Then I don't have to have any taxes withheld. And that's a big sticking point. Again, the easiest, fastest, least complicated way is I used to have my retirement plan at Stifel Nicholas. I never heard from those guys. It pissed me off. One day the guy from Edward Jones came knocking. And I hear from him at least once a year, so I'm happy enough. So I made a transfer. All my money from Stifel Nicholas went to Edward Jones. Did not go to me first. Went from one to the other. It's not a taxable event.
You get a 1099 for it.
It'll have a code G on it, saying that was a direct rollover.
They have to be the same kind of account. From a
They both
traditional
have to be-
IRA to a
yes.
traditional IRA.
Yes. However, okay, so yes, that's a true statement. If I go from one traditional IRA at Stifel Nicholas to another traditional IRA at Edward Jones, I'm fine. Now, so what can I do? There's what if I go from the traditional at Stifel to a Roth? Okay. As long as I do the direct rollover, I have to pay income tax on the distribution, even if it's direct, because I went from a tax-deferred plan to a tax-free plan. All the money in the tax-free plan has to go in pre-tax. Already pay taxes on. So I have to pay tax as the rollover comes out and goes in. But I'm not subject to the 10% excise penalty if I have not 59.5, as long as I did direct.
So you don't have to have $8,000 limit.
No, that's a direct rollover.
Conversion.
Yeah, thank you, that's the word. In this case, this is a conversion, it's not a rollover. I mean, it is, but it's also this conversion. I'm changing it from a traditional to a Roth.
And they will come to you, the client will come to you with that 1099.
It'll have the code on it.
Yeah.
Telling me why they're only paying tax on it and why I get to exempt them if they're like only 40. Why they're not subject to the extra 10% early distribution penalty. Because as long as they didn't take any of the money,
It'll either have a code on there for a conversion, or it'll have code 2, which is an early distribution with
exemption
exceptions.
applies.
Right, with exceptions. So
So if you change jobs, your retirement plan may end with your employment, and the employer may issue you a distribution. The total distribution of your retirement fund may be distributed to you, or you may make a transfer to another plan. Rollovers are done with Roths, IRAs, and traditional IRAs. And if you have a Roth, transfer to a Roth. Don't convert it. When transferring a retirement plan, generally no tax is paid until you withdraw from the plan, but we've already talked about the exception if I'm converting it to a Roth. Total distribution of your retirement fund may be distributed to you, and you may transfer it into another qualified retirement plan. Rollovers can be also done with IRAs and Roth IRAs. When transferring retirement plan distribution, generally no tax is paid until you withdraw it from the new plan, providing that I do it right. However, if you choose to receive the distribution, it is taxable to you in the year that you receive it, other than qualified Roth distributions, unless you roll it over into a new plan or a traditional IRA within 60 days. This is called indirect no rollover. Don't do this.
please.
It's a big pain in the butt. Let's see what type of examples they're going to run of this. The original plan administrator must withhold 20% from the taxable distribution made to you. So I'm planning on rolling it over, but for some reason, instead of having something set up where I can do a direct rollover, it's going to come to the money's going to come to me. Already, the plan administrator is going to take 20% withholdings for tax.
Boeing decides after 25 years to sell its company to Spirit, and they're going to divest every single employee's retirement. So they send you a check for $250,000 minus 20%. You get a 1099-R showing that your $250,000 retirement was divested out to you. $50,000 was withheld for taxes, and you now have $250,000 of income you have to deal with.
So Spirit still sell it.
No, I'm taking an
This is
example from what
Yeah,
happened
but
a few
are they
years
still
ago.
converting back to Boeing?
It's not relevant to what we're talking about.
No, I was just curious because my niece had said there's a glitch.
There's always going to be a glitch.
Yeah, that was.
Just go
something that
grease
we-
the right palm and then you'll get it.
That was something that we dealt with 3-4 years ago.
All right, so that means if I'm going to do a full rollover, I've got to come up with 20%. To do a full rollover, I have to add money going into the new account to make up for the money that was held to pay taxes. So one of the reasons why you want to do a direct rollover. Otherwise, it could get expensive. Because now, if I don't replace the 20%, and I'm not 59.5, I get to pay an extra 10% tax on the taxes. Because I didn't do a complete rollover. So there are incentives to do it right. But yes, so taking Matt's example, not only do I have to pony, if I don't pony up the $20,000, I have to pay 10% tax on 20,000, an additional 10% tax on 20,000.
No. You have to pay an additional 10% tax on the $250,000.
No, if I roll it over, I'm not subject to it. I'm only subject to the amount that I was short.
Right.
So if I didn't make up the
If you make
20%,
up the $50,000 that was withheld for taxes,
Yeah.
and are able to roll the full $250,000 distribution, you're fine.
yeah, you're fine. I don't have to.
That $50,000 that was withheld for federal taxes will go on your return as a federal withholding, and you'll get it back.
Yeah.
But if you can't come up with that $50,000 that was withheld, and you're under the age of 59 and a half, then you will incur a 10% tax penalty on the $250,000 withdrawal, which means in addition to all the other tax, they're going to tax an additional $25,000 in penalty tax.
So don't do that.
Please.
And by the way, even if you do go this route, you have 60 days
Fix it.
to get it right. Because if it's
Done.
day 61, you're subject to all of what he just said. All the penalties. Whether you do it right from that point on, 61 days or more, it's too long. Do direct.
Yep.
Never take the money.
Now you tell me.
Rollovers, I can only do one a year.
One indirect.
Yeah, one indirect.
You can do direct rollovers, and many direct rollovers as you want in a year.
Yeah, but they don't want to try and keep track of all the indirect ones.
Right.
1 year limit, 1 per year limit does not apply from rollovers from traditional to Roths. Well, because I'm going to pay tax on it, they don't have to worry about it. IRA to plan rollovers, plan to plan rollovers. Again, I never got the money. There's nothing to really keep track of, so keep rolling it up. Yeah. If I decide after, from Stifle to Edward Jones, and then the guy at Edward Jones pissed me off, so I want to move it to.
If you get a whisper on the grapevine that you're going to be divested out of a retirement plan, my suggestion, go down, take $1,000, open up a new IRA, and have your new person do a direct rollover before they can just divest you out.
Right. Yeah, be in front of it.
Yes.
And then go to your old plan administrator and say, here, this is where it goes. Don't send it to me. Actually, your new guy will probably do that for you, so you don't have to worry about it. I never had to contact staff and say, hey, I'm done with you.
Yeah.
Send it all to Edward Jones. The Edward Jones guy called up and said, hey, this client's done with you. Send us all his money.
Here's our paperwork showing we're the new administrators.
Right. I found somebody else to tell you that you're fired,
There you go.
And then Shane gets bad mouth for a week at Stifle, and Edward Jones throws him a party.
I get a little benefit or something. I don't know. All right.
And then
We've already
football.
covered this one, thanks to Sergio, so we don't have to worry about that. All right, so if you inherit a traditional IRA because you're the designated beneficiary, beneficiary could be any person or entity the owner chooses to receive the benefits of the IRA after they die. Beneficiaries of the traditional IRA must include in their gross income any taxable distributions they receive. So you inherit a traditional IRA, I can start taking the money out, I just have to pay tax on it. But I don't have to be of any age because it's not relevant. It's not my plan. So I could be 20 years old and start cleaning out grandma's IRA and not be subject to the extra 10% underage penalty.
And no, you can't roll it from their IRA into yours.
No direct rollovers are allowed when it's not your IRA to begin with. And that's the way the IRS looks at it. It's not your IRA. Yes, you're the beneficiary. Yes, the money in there belongs to you. No, it's not your IRA. It's grandma's IRA. They want you to clean it out.
And the only exception to that is if grandpa dies, grandma can assume the IRA and what she wants with it. It's her IRA at that point.
And that's a true statement, and including leave it alone.
Yes.
Okay.
Now, let's say grandma's children inherit a traditional IRA, but they don't touch it, they just.
There's going to be a point where they're going to be required to take it out because it's not theirs.
Once they inherit it, they have 10 years to drain it, or they lose it.
Right.
Oh, wow, they lose it?
Yes, the IRS will take control of it, and that will be IRS money. They thank you for your contribution.
Oh, thank you not.
Well, thanks for looking how much. I mean,
Right.
how much-
The plan administrator should already be in front of that for you. This should
Yeah.
not be a surprise.
They'll give you options. You can take X amount of dollars a year, X amount of dollars a month, or you can take it all right now. How do you want to do it?
You want a big lump sum now, you want to spread this out over the next 10 years, either way.
Your plan administrator doesn't want to send that IRA money to the federal government any more than you want to lose it to the federal government.
Let's see here. So we just basically talked about that. And we just talked about that. And we just talked about that.
Well, howdy doody.
And that. Yeah, and that one too. And it's here. Additional taxes because retirements or IRAs or other retirement accounts are tax favored. The idea is that you're supposed to leave it there until you're retired. There's a penalty for taking out too early. There are some exceptions to the rule. Penalties and additional taxes incurred on pensions, annuities, and IRA are figured out in any additional income tax owed. It goes on to line 6 in Schedule 2, Form 5329. Can be filled out to either, and 5329 covers a lot of things. It might be reporting the excise tax for over-contributions. It might be reporting the 50% tax on the minimum required distribution that you didn't take out. Or it might be reporting the tax benefit of, well, let's see here, I took my money out of a retirement plan, but I'm not 59 and a half, but I'm not subject to the 10% tax because of this reason. All of those things fall under this 5329 form. So when I see a 1099-R and it has a code 1 on it, and I know my client's 40, my first question is, hello, Shannon. My first question
Come on
is,
over,
why did you take it out?
come on over, come on over.
And if you tell me you took it out because you were starving,
You can have a seat.
that's not a good enough reason. You told me you take it out because you're about to be foreclosed on, that's also not a good enough reason. You told me you took it out because Junior's going to high school, or excuse me, university.
She's been out ill.
That works.
Took it out because you got a $40,000 hospital bill?
That works. Take it out because you owe the IRS $40,000.
Yeah.
They'll let you do that penalty free.
Yeah.
Took it out because you owe the state of Kansas $40,000? Yeah, not so much.
What
Yeah.
is the last four?
So there are other exceptions. I'm not covering all of them.
Last four.
I mean, the whole idea is to get you to keep that money in there until you retire. I'm not going to worry about the CARES Act, except to say that back in 2020 there was an exception that I could take money out and not be subject to the penalty because of COVID. I had 3 years to put it back. Obviously, it's 5 years. We don't really care about this anymore. I mean, there's still a couple of returns I can be doing. You know, a guy comes in, wants to do his 23 return. That still is in play. And this is all referring to that.
Okay.
This is all referring to the early distributions that I was talking
I
about.
know she said something
We'll
about
cover this
the-
again, but like you
we need
said,
the
it's here.
1099 SSA form.
I've already talked about this. I'm not subject to the extra 10% penalty because I'm dying. I don't need a retirement plan. I'm not going to make it there.
No, you need to talk to Social Security. Social Security.
I'm on
And
disability.
this is what you need
I
to
had to
tell
stop
Amy.
working. I need to drain my retirement plan. I died. Well, it's not really my problem anymore either, is it?
What is?
And we're doing 23, right? 2023?
Matt was right, kind of, in his $40,000
That's the
medical
form
bill,
we
but
need.
I only get the I can't write off. I
We
can't
need
exempt
this form.
7.5% of it
Okay.
of my adjusted
Yes.
gross income, which
Yeah.
will make more sense
So,
in
Just get
3
it
chapters.
and drop it off, and I will call you as soon as it's put in.
Yes.
Yeah, I do.
All right, thanks, hon.
I cashed out my IRA because I'm getting a divorce, and the wife gets a portion of it. I'm not subject to the extra 10% tax. Unemployed buying health insurance. Don't have to pay the extra 10% tax. First time homeowner, owe the IRS money. Qualified distributions to reservists serving while on active duty for at least 180 days. Which, from what I understand, the people that are going to Portland and actually aren't going to qualify because they're getting sent home at 29. So they wouldn't qualify for that. It's what I heard. I don't know what it's true. Now, like I said, 5329 is also the form you use to report this. This is the reason why I'm not subject to the extra 10% tax. Like I said, 5329 has lots of information on it.
Yeah,
Yep.
and it's 2 pages long.
Yep.
Be thankful that's all the longer end.
Yes. It could be worse. All right. Let's take 10 minutes and do the classwork here real quick. We're sticking together, damn it. Give me a break. Too much humidity. My ass.
Well, when you got talkers,
Now the evening class will be about 90 minutes.
He's not behind.
But
you.
there's a reason why I'm recording the morning class. I want this.
I know. Lydia didn't, I don't know if Lydia called him, or,
I think he just showed up. I think,
because he brought the wrong form. I remember that.
yeah, but I think he just showed up thinking he had a standing appointment.
Well, I wrote on the back of my card, he needs SSA 1099 for 2023,
Well, yeah, that.
and that he needs to go back to Social Security. And it looks like everything else is in, just not that.
Right. Because he never gets the right form.
You know, I probably could have done the math off the one she got.
And it might end up boiling down to that, too.
I don't think she realizes how to do it.
Well, I don't think she's comfortable with it.
Oh. Nope.
There you go, using that word again.
Car dealer.
Oh, you said car dealer?
Yeah,
Now, he didn't say his dealer this time.
Okay.
I said my car dealer should be happy.
That's not Matt, that's me.
That's
It's a dealer's right.
My Japanese guy keeps talking about amended returns.
Oh, no.
No.
no, he doesn't have anything worth amending.
But he brought me more receipts for 22.
Yeah,
I'm
but
not-
you and I
You
both.
got a refund. No.
It doesn't get any better.
I'm drawing the line.
Well, no, we got the maximum. Adding more to it doesn't help.
I need, right now he owes Kansas. If he can bring me more receipts, great, I'll put him in.
Right.
But right now he keeps bringing me duplicates. And last Wednesday he brought me in, Shane had already left. I'm kicking my shoes off. My foot is killing me today. So Suzanne ate it, but he brought Japanese food. Shane thought he cooked it himself.
I did not.
Oh, somebody's thought he brought it from Tapanuka, whatever the one is over there by Northern Tool.
Oh, that place?
Yeah.
I can't picture him cooking.
And I gotta go back through my text messages because he said I found $50 that I got paid, and I need to figure out what it is and what year. And if he would send me emails instead of text, I could print the email off and have it in my records. Not like this. Would you take this as a receipt? It lists the parts, it lists the shipping cost, the parts, and the total cost. So total cost was $880. Shipping was $245.
And then you have a itemized breakdown of what at least the parts were, right?
I
It
have each
sounds-
one. It was a motor, a controller, and a display.
It sounds like you have enough.
Yeah, it came from China. That's why it was so expensive.
But you also have a capital asset, not an expense. You need to depreciate it.
Those parts,
Prove to me they're parts. Right now, they sound like all part of something.
they are. They're part of an e-bike.
Okay, so they are
Because
parts.
he's getting into building e-bikes.
Oh God! Now you're getting into cogs.
Dude. He's not selling them yet.
Well, then you don't.
We're not doing cogs yet. That might be down the road, but not right now. Alright. Something told me to go back through these receipts because I was still in my ways. I can't find these on my list.
Yes.
Alright, are we close enough? Why not? Be thankful, I could hand out quizzes instead. No, I don't want to. Which IRS publication provides a worksheet to calculate the taxable portion of Social Security benefits? Which we didn't cover very well, so we'll just go ahead and give you that, 915. Although, I would also accept, although it's not a list on there, if you wrote down 1040 instructions, which actually was stated in there in the earlier lecture, which is not a type of retirement plan. C, the health savings account.
But it is necessary on the return.
Yeah. That's its own headache.
Yes.
When determining the taxable portion of a retirement distribution, which is used typically to report distributions. 1099-R. The simplified method is used primarily for calculating the taxable portion of distributions from annuities. This is the reason why I don't spend a lot of time on it, because most people don't have annuities. They have a traditional plan. Which IRA type allows for tax-free withdrawals in retirement, assuming certain conditions are met? Yeah, the Roth IRA. A direct transfer between retirement accounts is typically taxable, involves taking possession of the funds for a short period, is not taxable, requires withholding taxes to be paid. C. It's not a taxable event when you do it right, when you do it directly. If you do it indirectly, all those other things are true. What is the penalty for an early withdrawal from a retirement account before 59 and a half unless I have a good reason? 10%. If the taxpayer combined income is below the base amount for filing status, what portion of the Social Security benefits the taxable? Well, below is the key word on there, so none of it. Which retirement plan is specifically designated and designed for nonprofit organizations, public school systems, and certain ministers, which is that 403B plan?
What's that?
No,
All in types of
it would be under that section, and you have to extrapolate from there, because basically it did in the lecture mention the 403Bs being related to non-tax entities, and then from there you would extrapolate what this question is saying. There's not a direct quote for that.
Basically, it says 403B plans are for nonprofit organizations, and then leaves it to you to determine what is or is not a nonprofit organization.
To answer the question.
Yes.
Now, doing taxes, I don't give a. Doesn't matter to me.
No.
1099 is going to be the 1099, and it doesn't tell me, because I don't need to know whether it was a 401k or a 403b. It doesn't matter to me. It doesn't matter to the IRS at the distribution point. Which IRA is specifically designed for small business owners and self-employed individuals? That's the simple IRA. Long classes. Right.
Okay.
Maybe I'm having a mini stroke up here.
SCP, self-employed
Your eyes
plan.
are still functioning.
Yeah. And that's if you set it up through your work. Now, if you do it as, you could be self-employed and put into an IRA, but you're going to do it
As a traditional.
and take your adjustment to income.
Right.
like your Uber drivers can do that.
If I'm doing a Schedule C and I'm using my company to pay the retirement plan, then I can write it off as an expense.
But the retirement plan has to be listed under XYZ LLC,
Right.
not Sergio, whatever. If it's listed, if the IRA is listed under Sergio whatever, then it becomes an adjustment to your income because it's personal, not business. And you don't get to take it as business expense.
So if it's a Uber LLC, then.
Right, if it's Sergio's Uber Taxi LLC and that's what that ZEP plan is under, then you can take your $3,000 a year that you can put into that plan as
An
a
expense.
business deduction.
Yeah, as an expense.
It doesn't matter that the Schedule C is on your personal return, it's still classified as your business.
So if it's even your own LLC, you can still do that.
Yes.
As long as you do it through your business entity.
And that's not the only place, because there's this, I can do that also on healthcare plans.
Yep.
I can run it through my business and expense it, or I can do it individually and possibly write off as an adjustment to income. If I'm not using the health insurance marketplace, which is a whole other different problem.
Yeah.
All right, well, we're good to go. Got you out 6 minutes early. Congratulations. Honestly, I thought we'd be done faster than that, but hey, still early, technically.
At least we're on top.
Yeah.
This week.
We'll call it on time, yeah. You need chapter 5? Yeah, I get for you. Hang out for a second.
No, it's not. Joking.
Hang out for a second, I'll get it.
I figure it wouldn't hurt.
That's what it's there
Tell you what, and you had it just completely open there, and then you said it,
Are you going to a
your
pizza?
home that you thought was Italy is not.
Right.
I can't get the lid off of it. I can't carry certain pots and pans. Have it pulling down.
Yeah.
So
I have to go in there for doing
Yeah,
And
but
then I
it-
was then
I
I
do
visited
the
with
same
her
thing,
for a
I
while.
have my arms up
But then I
there.
slept right with
Yep.
Just messed me all back up.
And if I could get this, like, you sit still this part, and then this one thing going, it's gonna be like that.
Girl, I
for
feel
like
for
a
you
year.
over there.
I actually like doing this.
Yeah.
You know how to decide.
I know, but having to weed through them all and see which one's duplicate.
Well, that's all here.
It wouldn't be so bad, except
Clear to here, I mean, you can't.
if you look at my sheets, there's like an M next to it, a T, or
When we touch it,
an S, or a P, or an E,
See you guys.
or a G.
Bye.
You're trying to figure those out, aren't you? G, gas.
That's only.
E,
Like,
equipment.
oh, I was gonna say like.
Equipment, PPE, personal protective equipment. M, maintenance for vehicles, because he's not doing mileage. T is for tools, S is for supplies. Let's see what else. That's pretty much it. Yeah. So when I see a receipt, I'm not listing it all as tools. If you got a pair of safety glasses,
Okay, this is for,
this is safety glasses, this is E. This is a tool, this is a T. This is supplies like epoxy or something. That's an S. So I break it down on the receipt. So I can't just go down my sheet and go, okay, let me look for this total. I have to go back through the receipts.
And Lord forbid he decides to pick up.
It keeps bringing more.
You bring the what?
Lord forbid he decides to pick up a soda and a candy bar and put it all on that receipt.
Oh, no,
He
no,
has to
no, no,
subtract
no,
those
no,
out.
no,
not to do
no,
that.
no. Hold on, hold that thought, Matt. Hold on.
okay,
These are 3/4 of my, no, these are 85% of my receipts.
okay.
45-gallon trash bags.
Why can't you get the trash bags for when you use it? That's surprise.
I am not,
It voided it out.
yeah, he voided that one,
Oh.
He bought it,
And then
voided
voided
it
it.
out, and then bought,
something else.
and then bought something to drink.
He thought he could write off all his